Owning a property abroad. It's the dream, right? That little place in the sun. But when it's time to sell, that dream can quickly turn into a financial nightmare if you're not careful. We're talking about UK capital gains tax. Get it wrong, and it can cost you dearly. But don't worry, that's why we're here. This guide has been developed by the experts at My Tax Accountant to walk you through everything, step by step. Let's make sure you're ready.
So, the sale is going through. You've worked out your profit in euros or maybe dollars, and you're thinking about what to do with the cash. But wait a minute, have you thought about what HMRC is expecting from you right here in the UK? Honestly, this is the one crucial question that so many people forget to ask, and it's a mistake that can seriously sting.
Just take a look at that number. Over £26,000. That's a potential UK tax bill on a gain of just £100,000 for a higher rate taxpayer. Wow. Seeing a figure like that in black and white really makes you sit up and pay attention, doesn't it? It perfectly highlights the problem we're going to solve today. How to figure out this tax properly and, more importantly, how to legally get that number as low as possible.
To get you from confused to confident, here's our roadmap. We'll start with the absolute basics. Then we'll dive into the calculation itself. After that, and trust me, this is the part you won't want to miss, we'll cover the big questions. How do I shrink my bill? How do I avoid getting taxed twice? And finally, how do I actually report and pay it all correctly? Let's kick things off with Section 1. Okay, let's start at the very beginning. First up, your overseas property tax. Before we get into the how-to, we really need to understand the why. What even is capital gains tax? And why on earth does HMRC care about a property that could be thousands of miles away?
So what is this thing called capital gains tax, or CGT? Well, it's actually pretty simple. It's just a tax on the profit, the gain, you make when you sell something that's gone up in value. But, and this is the killer detail, for UK residents, this applies to your worldwide assets. That little sentence is everything. It doesn't matter if your apartment is in Alicante or your condo is in Florida. If you are a UK tax resident, HMRC considers that gain taxable right here at home.
And now for the main event. Section 2, calculating your gain. This is where we get into the nitty-gritty, the actual numbers. We're going to use the figures for the 2025-26 tax year to give you a really clear process to follow. And don't worry, I promise we'll keep the maths as simple as possible.
The whole calculation really boils down to these 5 simple steps. Think of it like a recipe. First, you figure out what you got from the sale. Second, you subtract all the costs you're allowed to, like what you originally paid for it and any money you spent on improvements. Third, and this is absolutely crucial for overseas property, you have to convert everything into pounds sterling. Fourth, you knock off any reliefs or allowances you can claim. And finally, you apply the right tax rate to whatever is left. Simple.
Let's make this real. Meet Amira. She's just sold her lovely apartment in Spain. Now, follow along with the table. Her gain in euros is pretty straightforward, right? Sale price minus cost comes to a gain of 110,000 euros. Easy. But now, look at the right-hand column. This is where most people get tripped up. HMRC wants every single transaction converted to pounds using the exchange rate on the day it happened. See how the rates are different for the purchase and the sale? That's why her final taxable gain in the UK isn't just a simple conversion. It's a very specific calculation that comes out to £108,898.
So, we have our gain. Now what? Which tax rate do we use? Is it 18% or 24%? Well, it all depends on your UK income tax band. The best way to think about it is that this capital gain gets stacked right on top of your normal yearly income. If that whole pile is still under the higher rate threshold, which is £50,270, you pay 18%. But if that gain pushes you over that line, any part of the gain in that higher band gets hit with the 24% rate. That's a huge jump, and it shows you why a little bit of planning can go a long, long way.
Okay, so you know how to calculate the tax bill, but let's be honest, nobody wants to pay more tax than they absolutely have to. That brings us to the fun part. Section 3, strategies to reduce your bill. We're moving from just doing the maths to being smart about it. We're going to explore the completely legal ways you can shrink that final number. And stay with me, the next point might just surprise you.
And here is our first pro tip. This is your first line of defense against a big tax bill. And you'd be amazed how many people just forget it's there. It's simple. Use your tax-free allowances. The big one here is called the annual exempt amount, or the AEA. Just think of it as your personal tax-free voucher for capital gains. Every single UK resident gets one every single tax year. It's a use it or lose it deal, and it means the first slice of your profit is totally, completely, 100% tax-free.
For the 2025 to 26 tax year, that annual exempt amount is £3,000 per person. But here's a little trick that makes it even better. If you own that property jointly with your spouse or civil partner, you can both use your allowance. And just like that, you've doubled your tax-free gain to £6,000. It's such a simple strategy, but it all comes down to having the right ownership structure in place from the start.
All right, next up is probably the most powerful tax relief of them all, private residence relief, or PPR. This is a big one. If that property abroad was ever your main home, you could potentially wipe out a huge chunk of your tax bill. Any period you actually live there is exempt. And here's the golden rule. The final 9 months you own it are always exempt, even if you moved out long before. It's a fantastic bonus. But, and it's a big but, you've got to have the proof. HMRC will want to see utility bills, bank statements, things that prove it was genuinely your home. Now, let's talk about the monster under the bed. For anyone selling property abroad, the fear of getting taxed twice. Once in the country where the property is, and then again here in the UK. This next section is all about making absolutely sure that doesn't happen.
It's the question I know is on your mind, right? You're thinking, wait, after I've paid tax in Spain, is HMRC seriously going to demand another slice of the exact same profit? Well, take a breath. The system is designed to stop that from happening, but you have to know how to work the system and claim the right relief.
And your secret weapon here is called foreign tax credit relief. Basically, because the UK has tax agreements with loads of other countries, you can get credit for the tax you've already paid over there. But here's the rule you've got to remember. The credit you get is always the lower of the two amounts, either the foreign tax you paid or the UK tax you owe. Think of it this way. You can use it to wipe out your UK bill, but you can't get a cash refund from HMRC.
Let's jump back to Amira and see how this relief is a total game changer. So her gain was over £108,000. We knock off her £3,000 allowance. At the 24% rate, her UK tax bill would have been a painful £25,415. But now, look at that magic line. Less, Spanish tax paid. She'd already paid £20,690 in Spain. She can claim that whole amount back against her UK bill. And her final UK tax? It plummets to just £4,725. What a massive, massive saving.
We are so close. We've calculated the gain, we've figured out the tax. Now for the final practical hurdle in Section 5, actually reporting and paying HMRC. Knowing the deadlines and ticking the right boxes is just as important as getting the numbers right.
Now listen up, because this is a point where a lot of people go wrong. You report the gain from your overseas property on your normal annual self-assessment tax return. You might have heard about a really strict 60-day reporting deadline for property sales. Let me be crystal clear. That only applies to UK property. For your overseas property, you get the standard, much more generous deadline, the 31st of January after the tax year ends. That is a crucial difference to remember.
Phew, we have covered a lot of ground. So let's bring it all together in our final section, key takeaways and your action plan. This is all about boiling it down to what you absolutely must remember and what you should do next.
If you only take one single thing away from our chat today, please let it be this. Keep amazing records. I mean, everything. The original purchase contract, the legal fees, every single receipt for improvements, even records of exchange rates. Keeping a good file makes this whole process so much smoother and safer if HMRC ever comes knocking. Seriously, future you will thank you for it. Now, before we wrap up, I have to say this, and it's really important. The information we've gone through today is for general guidance. Tax is complicated, and everyone's personal situation is unique. So please, you shouldn't rely exclusively on this information to make big financial decisions. Because every case really is different, you absolutely must speak to an expert before you make any final decisions. The specialists at My Tax Accountant who put this whole guide together can give you advice that's tailored specifically to you. You can give them a call on 0208-570-8531 or drop them an email. If you want to go over this again, you can read their full detailed article on their blog. And for more fantastic tax tips, make sure you subscribe to their YouTube channel. Thanks so much for joining me today.